All right. Welcome back to another episode of the Tim and Tim Show, live every Tuesday at 10 a.m. Eastern Time. Tim and Tim Tuesdays at 10. My wife loves that alliteration. She's the one that helped me figure that one out. But we're back for another great, fun episode where we are talking about current events. We're talking about experiences in commercial real estate. We're honest and transparent. We got nothing to hide. And for those of you that have been watching our show for a very long time, you know we talk about real stuff in real time, and we ask for people to provide their opinions. We want your feedback, and ultimately what we try to do with this show is we want it to be engaging so that other people can learn something from the show and we can learn something ourselves. I mean, everyone's got a different perspectives and everyone has different experiences, and we by no means know it all, but what we can talk about is what we've experienced. And this week what we're talking about is how the real estate crash has already happened and no one's really noticed. Tim, how do you feel about that? How do you feel about nobody noticing the crash?
Um, I think a lot of non-operators haven't noticed. Um,
Oh,
oh,
that's super fair. That is entirely fair because if before, sorry to interrupt you, but what I think there is that people haven't really felt the crash because the vast majority of people either don't own commercial real estate, they don't operate it themselves. Maybe they've invested into it passively, but most 99% of people, maybe 98% of people, they relate it to the single family housing market. Agree or disagree?
yeah, yeah, yeah. No, I agree with that, and I also think like the media doesn't pick up on it as much
Absolutely not.
when it's hitting perceived companies as opposed to people, right? Like when mom and dad are losing their apartments, I mean, sorry, their homes, their
Mhm.
places to live.
People
I think.
feel that.
Yeah, well, and I think it makes for a better story than, hey, these guys who bought a 200 unit apartment complex are struggling and they had to turn it back over to the bank, right?
Yeah,
Like,
they're like, "Oh, boohoo, big deal,"
yeah,
business venture gone wrong.
right. Um, but yeah, I mean, I think some operators have noticed. I think some investors have noticed. Um, I think there's a lot of investors that don't necessarily understand the fundamentals behind it. Tim, we talk about being transparent and stuff. Tim and I get questions from investors sometimes, and um, quite frankly, it's kind of like, hey guys, like what we're doing is specifically trying to avoid what you're referencing that you saw from somebody else over here, right?
Mhm.
And I
Thanks, Dennis. All facts, no fluff.
yeah, so I think I think sometimes that points out it's like, hey, I'm trying to protect you. Like what I'm doing, you see is like, I don't know, a problem, and I'm trying to protect you. And this is not what we're trying to talk about today, but what I'm ultimately getting to is like, I don't think investors quite understand the dynamics that are going on, and the fact that there's a crash. If it's not hasn't already happened, it's happening around us right now.
Mhm.
um and there's a huge impact from this.
Yeah, well,
And
let's think about the last 2 crashes, right? First, more relevantly was the dot-com bubble, right, in the late '90s, right? People could visually see that. They could see the stock values go up and then crash
yeah.
back down. You could visually see that there was a loss in value. The second most recent crash is the 2008 housing market crash, where almost everybody in America was affected by single family home values, either
Mhm.
your own personal house or your mom and dad's house or some investment properties that you may or may not have had, because people buy houses and they move into another house and they keep it as a rental. So they feel that, right? It's way more relative when it's in the stock market and more relative when it's your single family house, because it
You can
makes an
see it.
impact. You can see it and it makes an impact on your daily life. And the water cooler talk, or the deli chat, right? When you're picking up your egg sandwich in the morning, is, oh, housing market's in the crash, in the gutter, stock market's in the gutter. And most people have investments in those types of assets. The less commonly known asset that's being disrupted right now, that's had a crash that hasn't really looked like what most people are relatively comfortable with over the last 25 or 30 years, has been commercial real estate. It's no surprise that office space has been absolutely crushed by COVID and the work from home culture. And it's been all over the news, right? I mean, there was recently, I think it was an ad, not an ad, but a post, and they were talking about how this property, gosh, where was it? In like Chicago or something. I can't remember where the city was, but it was like this $80 million 30 foot sky or 30 floor skyscraper that was completely vacant, sold for like $3 million. And like 5 years ago, it sold for 90 million, you
Yeah.
know? And those are the headlines that what you're talking about is it makes good journalism, right? Is if you got a catchy headline and people are attracted to it. And what's not so commonly talked about, and you don't really know it unless you're invested into it or operating it, like Tim said before, is commercial real estate, multifamily, self-storage, RV parks mobile home parks and RV parks are affected in some way, shape, or form. Triple net stuff, flex space stuff, like all of the commercial assets that are not really publicized. If you're not looking, you won't see the change in value, right? But the people that own and operate and invest into commercial real estate are feeling the change in the values
Yeah.
around them with all commercial real estate
Yeah,
values.
and I think I think it's a big part of it, right? Like you're talking about, you see it versus feel it, right?
Yeah.
And like back in 2008 and 9 and even 10, like I can remember driving around, and you would see signs in front of houses that would say bank owned or foreclosure, or I mean literally in the front yard. And then quite frankly, you could also just drive by and you'd see a house with no lights on that looked vacant. The grass was, 3 feet tall, stuff like that. That building that you're talking about in Chicago, I guarantee you, nobody that walked by that building on a daily basis in
Yeah.
Chicago looked
Right.
at that building and said, that building's in foreclosure. It's in
Yeah.
distress. It still looked like a building. It probably looked like it was pretty much occupied for the most part from the
Mhm.
street. So,
Yeah.
it's harder to see it in the commercial space. Um, the one the one caveat I would say to that is probably like malls, right? Um,
Oh, yeah, dude,
you
shopping malls, yeah.
you
What
can
was it?
drive by a
Wakefield,
mall.
right? Was the major, like, owner
Yeah,
of malls around the country?
you can kind of drive by a mall and be like, there ain't nothing in that mall, right? Like,
Mhm.
yeah, that's, I mean, first of all, there's no cars in the parking lot. Second of all, the grass is high, but you can kind of tell, right?
Mhm.
Um, and so I think it's just harder to see and recognize in the commercial space, but it's there. It is
Yeah.
absolutely there.
I think a good way to classify the reduction in value of commercial real estate is calling it the quiet crash.
That's pretty cool. I like that.
Uh, I
Um,
mean, it's not publicized. You can't see it. You can't really feel it. You
right,
only know it if you're involved in it.
right.
And for those of us that are involved in it, it's a world of pain right now, right? So let's talk about what's causing the core reduction in property values. It's no secret. We talk about it every week, right? It's operating expenses have increased 20 to 30% or more, depending on where your property is located. Property taxes have reassessed in a lot of states and a lot of regions over the last 5 years because they're generally on like a 5 to 7 year revaluation process if they're not done at like a point of sale. Um, Insurance premiums, if you're coastal, like you've seen 200-300% increases in property in insurance costs. Non-coastal exposures have had some increases, right? But maybe not as substantial as 100% increases, but even a 50 or 60% increase in operating cost of your insurance cost is a drastic increase. Um, with bank rates, with debt and interest rates going up, cap rates have decompressed. And for those of you that don't know, commercial real estate valued off of its NOI divided by the cap rate. So as the cap rate goes up, the value goes down. As the cap rate goes down, the value goes up. So we want cap rates to stay low because then you're getting a higher multiple of your NOI instead of the inverse. So that has quietly affected property values. And the biggest thing that's causing people to go into foreclosure is they can't refinance or sell to pay
Right.
off their first lien position, and that's why they're losing money. And that they go into foreclosure because the landscape of commercial real estate has fundamentally changed with the increase of operating expenses. Now, there is an argument to be had in the revenue has gone up, right? But what we've seen is the revenue's gone up so fast that it's priced out a lot of people, and
Right.
your B class asset now becomes a C class asset because they can't afford the level of rents as you go up in scale, because a 10% increase on $2,000 a month is $200 versus a 10%
Yeah.
increase on $700 a month is $70, right? So at the end of the day, your revenue is going up, but not as fast as your expenses. So with your NOI going, your expenses are your revenue is staying flat or going down, your expenses are going up, and your NOI is diminishing.
Yeah.
Combined with cap rate decompression, so you have a smaller NOI, combined with cap rate decompression, meaning the rates are going up, your property values are just plummeting. And that's why the commercial real estate world is getting hammered right now. And nobody really feels it unless you own it, you operate it, or you invest in it.
Yeah. Yeah. And and the other thing too that you kind of got going out there, you have a couple certain markets. And guys, I'm going to preface this right now by saying this is not a political segment, but I'm going to say this is something that dawned on me this past week that I've reached out and asked some other guys about, and they're seeing it as well. Is especially in the C class space, the workforce housing space, um, we're seeing a lot of impacts from deportation. Um,
Yeah.
yeah, I happen to know a property where they've gone from like pretty steady 94, 95% occupied down to the 70s percent occupied, which is under their break even number. Um, and certain markets are seeing this a lot, not just on one property, but they're seeing this a lot because a big portion of their tenant base is being gathered up and sent out of the country, and then the rest of the tenant base gets scared, so they just go leave.
Hmm.
They leave before they get caught. This is impacting a lot of stuff. So you got what Vitali's talking about. You got cap rate decompression. You got the revenue going up, but the expenses outpacing kind of those revenue increases. You got things like tenant issues, like deportation items. You also got other things in certain markets where you have a lot of A class luxury housing that has come on the market, and that renter pool has diminished, right? People are
Hmm.
getting laid off. People aren't getting the raises they thought they were going to get, things like that. And so that $2,000, $2,500 rent for that A class isn't happening. And builders are having to make concessions. And you know
Hmm.
what happens when you get concessions at the A class level?
It all flows
they
down.
they roll down. All of a
Yep.
sudden, your B class that was getting 1,800 has to go to 1,500, and your C class that was getting 1,000's got to go to 700. That kind of stuff. So,
Yeah,
um,
and the jobs report came out recently, and
yeah,
the unemployment rate climbed from 4.1 to 4.2, but economists are saying that with corrections from prior months, in order to make the corrections for prior months of unemployment rate, that they think the true unemployment rate is closer to 4.9 or 5%. So there's
mm,
been economists all over everywhere right now screaming that they're going to start making emergency cuts to the rate. I don't see any emergency cuts to Fed rates and things like that, but I do see rates being cut in the next, they're saying maybe 25 basis points at the next meeting. If you look at the CME Fed Watch tool, the probability doubled. They went from like 30% to 60% probability of a 25 basis point rate cut. And for those of you that don't know, when the Fed cuts the rate, that is a hedge against a recession. Okay. So when they believe that the economy is going down, they reduce the rate, the Fed funds rate, so that people are enticed to spend more, they're enticed to borrow more. That keeps transactional volume high because people make money when they transact. Like car dealers make money when they transact, not when they manufacture it, not when you've owned it for the last 10 years. They make money when you transact. So you need to make sure that there's continual transactions in the marketplace. And by reducing the Fed rate, that is supposed to spur spending, right? To keep the economy more in equilibrium. When the economy is growing, they have the ability to increase the rate to kind of slow down the rate of growth to keep it steady. So like that's the tool that they use. And one thing that people are screaming about right now is that they should have cut rate, in at the July 30th meeting, that they should have cut the rate. And everyone's like, well, why would they have cut the rate? Everything seems okay. And the only thing that would induce a rate cut is if the economy is going down, right? I mean, The easiest way to think about that is during COVID, when everything got shut down and nobody was doing any transactions at all, they cut the Fed rate to like zero. And the whole point of cutting the Fed funds rate to zero was to spur the economy, to prop it up, to continue it so that it helped keep us out of a recession.
Yeah, but here, because you said it a few minutes ago, though. Here's one of the concerns I have. I literally had this conversation over dinner last night. One of the concerns I have with that is like you want to spur spending. Well, even without spending in a recession on the line, we're looking at price increases.
Yeah.
Like we're in a market right now where we're talking about a recession. We're talking about people cutting back on spending,
Hmm.
yet we're still seeing inflation. We're still
Yep.
seeing inflation. We're still seeing costs of goods increasing. We're seeing it at the property level, right? Like our
Yep.
expenses to renovate and buy materials continue to go up. They haven't stabilized. They continue
Mm-mm.
to increase. So now we're talking about reducing the rate, printing money, spurring, incentivizing spending while we're in an inflationary period already. That's kind of a recipe for disaster, man.
Hmm.
That concerns me quite a bit.
Yeah. I don't, I mean, what we're walking into is pretty insane. I mean, on a
Yeah.
global, or macro economy level of the United States and the dollar value. Many people are calling for the devaluation. US dollar is the global currency, and people are saying that the USD is going to come off the global currency because of the rate of inflation that's going on in our own home country. Um, I mean, these are unprecedented times. What's really going to happen in the long run? Nobody really knows for sure. But if you look, what did they say? History doesn't repeat itself, but it often rhymes. And they start making comparisons to other cultures and countries and currencies and things like that. And how, what we're kind of going through is the same thing that other currencies have gone through. USD was not always the global currency, right? So why don't you do a little research on global currencies before it was the US dollar? What are some things that happened in those countries or global economies that caused the change from one currency to US dollar? You know, man, somebody, I bet you somebody way smarter than me has written a book about it. But yeah, I mean, just there's uncertainty in the market all over the place, and nobody really knows what's going to happen. But it's like once you start to see fall in pricing for single family houses and you start to see that's another thing, the stock market all-time highs. I think it reached all-time highs again this week, and it's like, okay, how what's the all-time high? How high can it go? We keep talking about reducing rate and spurring spending, and the stonks always go up to the right, but that's not entirely true.
No.
We have seen some pricing corrections in the last couple of months. I mean, earlier this year there was a huge price correction and kind of shook out a lot of people, but did that set us up for the next run up? Who knows? I mean,
Eh,
it's investing at its core is risky, right? There's no guarantee. You have to do a lot of research and have an understanding of what you think is going to happen. And let me tell you, folks, sometimes you make money, sometimes you lose money, but that's inherently the risk. That's why you don't put all your apples in a single basket, or
Yeah.
eggs in a single basket.
Either way, either way, it all works, right? Whether you invest in eggs or apples or tulips.
Mm, yeah.
The
Um,
I but at the end of the day, man, like we started off this with like, hey, I think the crash has happened. But it kind of sounds like we're talking about I think the crash is going on.
it's going on. Yeah.
Yeah.
One of the interesting things that I think is an indication of how valuations are changing is the amount of creative financing and seller financing that's going
Oh
on,
yeah, yeah.
right? I mean, what that tells me is the equ- um, liquidity is drying up, right? So in order to make a deal work, right, because people need to transact, in order to make a deal work, you end up having to give concessions in terms of seller financing, basically leaving equity in the deal in a different position in order to enable the next guy to come in and breathe fresh life into it.
Yeah.
Because values are getting crushed. LP investors are more scarce right now because a
Yeah.
lot of investors have not been getting preferred return distributions. They maybe have not been making money on exits, and might be doing cash in refinances. Obviously us as well, GP LPs, relationship is synonymous there. But that sentiment in the commercial real estate market is causing a quiet crash, right? I mean,
Yeah.
those are a lot of the reasons why people are not transacting as much, and it's difficult to raise money. And shout out to all the mentors out there, but Tim Bratz specifically for me, he always talks about when there's real estate deals everywhere, there's no money to be found, and then the table it's either a lot of deals and no money, or no money and a lot of deals, right? And trying
Yeah.
to figure out how to make it work. Now is the best time to be making it work, because if you have no money and a lot of deals, you have a lot of opportunity to do seller financing and make deals happen,
Yeah. Yeah.
which I love.
And and in fact, guys, like we've had some questions, because Tim and I did a ton of transactions in 23 and 24,
Hmm.
a ton. And this year we've done none. We've had no acquisitions in 25. And now, before anybody says anything, because we've been talking about we're buying, we're buying, we're buying. We're buying. We'll buy all day long. We're just being
Hmm.
really, really picky about what we buy.
We haven't
Um,
closed on a purchase since September of last year, so it's coming
yeah,
up on a year of no acquisitions.
yeah. I think this is a great, 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 great time to buy. I just You just need to be really picky.
Yeah.
Like Tim's talking about, like, hey, the types of offers we're putting out there are very, very creative.
Hmm.
And they're very much in the kind of buyer side of the pool. But they're very creative, and it's not, and we're certainly not going after anything where we're like, hey, I'm gonna do a ton of work and I'm gonna get paid this much, right? It's more like, hey, this is where the deal is, this is where it makes sense. We're sticking to that. And if
Hmm.
that doesn't work for you, then okay, good luck.
Yeah,
Um,
and if you guys weren't here when I did my solo shows and I talked about some of my own investment strategies and changes, that's what Tim's talking about. Is like we're making a lot of deals and we're making a lot of offers to buy things with seller financing structures, with minimal down cash out of pocket for Tim and I, with favorable debt structures, and we're helping the sellers solve their problem of like tax problems and inheritance tax and sales tax and capital gains. And the more you can educate yourself on learning about those strategies, the more opportunities are going to open up to you. But I can tell you, Tim and I have been working on a deal that you actually drove by yesterday, I think it was,
mhm.
that this one deal will, based on the in place cash flow, will change our lives. Right.
Right.
And one thing that we're paying way more attention to now is, okay, well, how much is the property making today? How much is the debt service today? And how much cash flow does it make today? And it's not more so of a, okay, well, what's the value add that we can complete over the next 12 months and see cash flow later? It's no, 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 no.
Yeah.
We're going to make sure it cash flows today, because if those things don't happen, we can still pay the mortgage and be comfortable.
Yeah. Yeah. And Tim, it's funny you say that kind of thing, because I've had guys, when I'm on the road a lot, I do a lot of phone calls from the car. A lot of that's like broker relationships as well. I've had four. I had two yesterday and two last week. I had four broker conversations with four different brokers, and they all said some sort of version of the same thing, and it was either, hey, basis plays are really kind of dead at the moment,
Correct.
and right, and the 1% rule has made a comeback.
Yes.
And I heard two different brokers tell me that they've had investors or had buyers come to them and say, doesn't meet the 1% rule. I'm not even going to underwrite it. Doesn't
Hmm.
meet the rule. Not going to underwrite it. Now, Tim and I look at it a little bit different. We're like, if it doesn't meet the 1% rule based off, you like a standard underwriting, is there something creative we can do?
Well, how can
Right.
I make this I mean, that's how we came
Right.
across the deal we're talking about right now. Is how can
Right.
we make this deal work? This is the price that they want. And I
Right.
immediately said, I think it's too expensive. But then the conversation was, well, they don't have any debt on it and they're willing to hold paper if you make them an offer.
Right.
Oh, okay. Now you give on price, take on terms, right? Because we can make sure that we cash flow substantially today to cover up any changes in valuation. Because if you have
Right.
5 or 10 year fixed rate debt and a 1.5 debt coverage ratio, meaning for every dollar in debt service you pay, you make $1.50 in NOI, right? So $100,000 a year in debt service, $150,000 NOI, that's a 1.5 debt coverage ratio, right?
Yeah.
um, doesn't really matter to me because I got $50,000 a year in cash flow that I can use to do whatever I need to. So the change in valuations and rates doesn't really affect me now. That's a 5 or 10 year down the road problem.
Yeah. And you're also seeing, and by the way, the basis plays that you do see happening are becoming more risk adverse. You know, like lenders talk about they change their risk profiles depending on the market, right? Well, buyers are doing the same thing. So it used to be it's like I'll buy a 2 cap that I got to be able to take it to a 6 cap, right?
Yeah.
Well, today they're like that. I'm not even looking at a 2 cap unless I can take it to a 10 cap,
Yeah.
right?
Minimum.
So
Right.
right. And so it's like that risk profile on basis plays has completely changed. In fact, Tim, you and I kind of had the same thing. We had a deal under contract, and um, it was a very strong deal at the right numbers. Tell me if you're shocked by that statement.
Every
You
deal's a
know,
home run at a certain price.
yeah, but basically, Tim and I went and said, "Hey, this is where it makes sense. Based on this, this is where it makes sense. This is where it makes sense and is worth our time to do the deal. It's a
Right.
high risk. There needs to be high reward." And the seller came back and said, "Hey, wait a minute. Let us get creative with you." They came back, offered seller financing, full seller financing, but they increased the basis so much that Tim and I went, "No, I'm going to do the same amount of work. I'm going to make half the money. Not doing it.
Yeah.
Not going to do it."
Right.
Right. And so that's the kind of thing you're seeing right now is like some of those fundamentals that we used to see before, those rules of thumb, they're coming back in a strong way.
Yeah. I mean, and that just further supports the buyer's market, sentiment, right? It absolutely totally is buyer's market sentiment right now. I love being in the position of I don't have to buy something right now, but if you need to sell it, maybe I want to buy it. I want to buy a lot of things, but I don't need to, right? And that puts you in a really good authority of power of authority.
A good
I don't
position of
know.
power.
Position. Thank you. Sorry, I'm a math guy. I'm a numbers guy, and the words don't usually flow off the tongue that nicely. Hey, shout out Matt Reese. That's really nice of you to say. Appreciate the kind words. And Tim and Tim, we try to be as transparent and honest and help educate the masses here with our show. I mean, we've been doing this for 3 years now. I absolutely love doing it. And I hope everybody that listens to it gets a lot of value out of it. I mean, that's all we're here to do is to throw the rope down, pass on our wisdom and knowledge, and learn from our experiences and our mistakes, and try not to make the same ones yourself.
Yeah.
So, yeah, I mean, gosh, there's just so much to talk about with how the valuation has changed, how the sentiment has changed, how some fundamentals are coming back into play, which are great. A lot of people that bought deals in 2020, 2021, and into 2022 that they underwrote aggressively. They thought that cap rates would continue to stay low. They thought debt was going to stay low. Those are the people that are really suffering right now. Thankfully, we followed a lot of general rules of thumb and some common sense of like, well, do we think it's going to stay this low forever? No, right? That's hopefully optimistic that we thought things were going to stay that low forever. That's ultimately why it was so hard for Tim and I to find our first handful of deals, was
Yeah.
because we were too conservative on our underwriting. But look at us now. We're not the ones that are turning the keys back in like everybody else because we followed those rules of thumb. And we said to ourselves, if the rates are low now and everything is cyclical, do we think the rates are going to continue to go down or continue to go back up? Well, we're like, we're going to go back up, right? So paying attention to all of those metrics and kind of the economy as a whole is important. Multifamily got absolutely crushed in the last 24 months, and people are really feeling the pain. But self-storage and retail, one thing on self-storage, I don't own any. Well, I guess I do own some self-storage, but it's not like a self-storage facility. I have never really been a big fan of self-storage. I
Mhm.
sincerely thought that it was being overbuilt. I think that it's everywhere. I think it's yes, people are going to have stuff. They're going to need a place to store things, but ultimately, people always have the choice to throw it away. So that's why I never really thought that self-storage was something that needs to be built in such quantity that it has. And there has been some reduction in value in self-storage just because of the overbuilding of self-storage. So, I learned that from one of our partners, the Roushes. They build a lot of self-storage. And when Tim and I owned a piece of land and we were looking at doing a self-storage development, they were
Yeah.
like, guys, this doesn't make sense.
No.
Look how many self-storage facilities are in the area. Now, The opposite is true with multifamily, to make sure that, you know, you're buying and building and developing in places that have high population growth. That means you're going to have demand for your units, and supply and demand at the end of the day is going to be the rule, you know, the rule that you have to follow. And with self storage, I just saw that it was, I just felt that way. I just never was really super intrigued by it. Multifamily, I understand it. It's always a necessity. It's never going to go out of style. And that's why we continue to invest in multifamily. And despite the changes in the economy and the markets that we're seeing right now, we're still trying to buy stuff. I mean, actively trying to buy stuff, but we're being super
Yeah.
picky. And you know, our investment thesis has changed a bit, and our goals and our aspirations have changed a bit. But not to say that we're not buying stuff anymore. We are absolutely buying stuff.
We're just, yeah, like you said, we're just being pickier. And then guys, like one little piece of advice, just in my opinion. Um, I've been doing some stuff with it this week on social media, but you know, regardless of what your political opinions are, the big beautiful bill, it is what it is. It passed. It's happening. Go out, get familiar with it,
Hmm.
because there are incentives in there for us,
Hmm.
right? There are incentives in there for those of us doing this business. So go get familiar with them, figure out how to apply them.
Yeah.
And then, two, there's very specific areas of the country that are going to benefit from this bill based off the way it's structured. So I would basically look to see like how your market, or if your market, can benefit from it.
Hmm. Yeah.
There's, for example, there's a very specific corridor within the Carolinas that's going to do very well based off this bill. Um,
Hmm.
and we'll be looking through there. So
Yeah. So, all right, guys. Well, hope you guys learned something today. Appreciate everyone joining. If you're watching the show later, you know, make sure you leave a comment, and we respond to all the comments about your thoughts and values and everything that you learned from the show. So, again, always appreciate it, and we will see you next week. Peace.
see you guys.